All right. Good morning, good afternoon, good evening, wherever you're from. All right. Let's check if we're actually live on LinkedIn. LinkedIn's acting up a little bit slowly today. We are go. Right. All right. Looks like there are one or two people still dripping in here. So if you're okay with it, I'll actually give them just a few more minutes to
No problem.
come in. Stream is looking good. And let's give them another 30 seconds. Right. I like it. I like it. Looking good this side. All right. We've got 10 views on LinkedIn so far. Wow. That's interesting. Should we give them just one more minute? All right.
Yeah, sure.
All right, everybody. Welcome to Alternative Investing. Everything you are too scared to ask. Right. So this one has been coming on a long time. There's already a couple of questions coming in. The first one, yes, it's going to be made available. The recording will be made available. It's also going to be on LinkedIn, but we'll also put it on YouTube and all of the other channels afterwards. So don't worry. Yes, the deck as well. The deck is also going to be made available. So everything we're going to talk about today will be made available after. If you're not tuning in live, you'll probably get it first. If you're not, you might need to wait a couple of days. Right. So thanks everyone for joining. This has been coming on a while. It did take a little bit of arm twisting to get Karson to actually do this. And I'm finally glad we pinned him down and he's here and he's going to spill the beans for us today on alternative investing. And we are super, super excited about this. Right. So before we continue, questions at any point in time, we've got unabridged access to one of the creator lines around alternative investing in South Africa. He doesn't like it when I say that, but if it's true, it's true, right? And you also might notice that I'm not as handsome as that little gentleman in the far right of your screen over there. That's Lavesh, unfortunately couldn't make it today. So you're gonna have to deal with me just I'm asking all the right questions, and I'm not gonna go easy on him. I'm sorry, Karson. This one's going to be tough, right? Max Agility, Karson, welcome. Do you mind just taking a second just to introduce yourself and tell us all about who you are and what you do?
Thanks very much, Bruce. I know that this is a long time coming, so I'm glad that we're finally here. I'm Karson, managing partner at Max Agility. I'm also a partner at Zion Venture Partners, which is a venture capital firm here in Johannesburg. We originate investment transactions for our clients across alternatives like private equity, private credit, venture capital, hedge funds, commodities, energy, and then help them raise capital for them.
Right. Well, it sounds like you're the right person to speak to about this. Are you giving financial advice today? Let's just get that out of the way.
Yeah, I've got all of our disclaimers out there, right? So if anybody's looking for financial advice, I think the best thing is find an accredited financial advisor and get some good advice from that individual.
Right. Perfect. Let's just jump straight into it. Karson, what are alternatives?
Good question. So I consider the conversation to be between traditional and non-traditional assets. I think it's much easier to think of alternatives by what they are not defined as. So traditional investments are cash, bonds, and stocks.
Right.
And these are then housed in traditional vehicles, which are unit trusts. They are retirement annuities. They are endowments or tax-free savings accounts. Alternatives for our firm can be broken down into two. First are core alternatives, which are private credit. They are private equity, venture capital, hedge funds, commodities, distressed real estate. Our non-core alternatives are crypto, collectibles, and art. I think clients venture to non-traditional assets to access opportunities that are uncorrelated and not available in the public markets.
Yeah, I was really hoping you'd say crypto over the just to be sure you're not talking about meme coins, right?
Absolutely
You're not talking about meme coins? Right. Okay, great. And then I think one of the interesting asset classes that I've come across recently is actually like whiskey casks, whiskey casks. Would that be included in non-core as well?
Absolutely. So core is where we see a lot of the appetite, but you do get some outlying sectors like whiskey. I think it's more around the need that people want to find an asset that doesn't have a crowd behind it. And if you're thinking of whiskey casks, I don't know anybody that's currently in that field. So maybe that stands to reason.
Right. So we're looking at things that are not available or readily available in public markets, which means we need to sort of find out what's available in the private markets. But first, what are private markets?
All right. So at the most basic level, private investments are assets or financial instruments that are not listed on a public exchange. They are investments that are made directly into private companies. And since private companies don't trade publicly, there's generally less readily available financial information about them. These investments are also less liquid than a stock that is bought and sold on a major exchange or a corporate bond that trades over the counter. The limited liquidity and transparency in private markets are two of the biggest differences from public markets. And I think these are factors that an investor should be made aware of before allocating to this asset class. An interesting stat, Bruce, is that more of every economy globally is in private hands anyway.
That's super interesting. Why is there a need for investment into private markets, specifically, Karson?
I thought these were going to be easy questions, Bruce.
Not today. We're not off the hook today.
All right. I think one of the slides that we've got just shows that private investments can be a very valuable diversifier, in part due to the much wider pool of companies that are within private markets versus public. So a quick stat says that there are more than 1,000 private companies globally with annual revenues above $100 million US, compared with just 19,000 of these companies that are in public exchanges at the same revenue level. We see fewer listed firms, example, on the US stock exchange, but these big firms are indeed getting bigger. Listed firms in the US have almost halved since 1995, and at the last count, it was around 4,200. An interesting stat that Lavesh and I have seen at the height of the dot-com bubble was that the top 10% of US stocks had 72% of the market. The same percentage applies again in the GFC or the global financial crisis, and now we are seeing it at 75%. So make of that what you will. Crazy,
All right, so we're talking about international. Yeah, absolutely. Talking about international markets, though, what about closer to home? What about right here in Mzansi?
All right. I think the same holds true to a certain extent here, that companies are staying private for longer. I think mergers and acquisitions has a huge part to play in that. The investable universe is shrinking in terms of finding enough companies to go through. But this does not necessarily mean that it's a weaker market. I've got to stress that point enough.
So that's pretty interesting, right? But that means there's obviously fewer opportunities. But I'm thinking of this payment processing company. I'm sure everybody knows about Stripe in the US.
Absolutely.
And if they ever were to go public, they probably have the biggest IPO in history, and they're sort of swallowing up the world of payment processing right now. How would we get exposure to a company like that? Ordinarily, at this point, they've raised so much they probably would never have or never go. How would we get exposure to something that unique and that exclusive?
Absolutely, it's a great question. I think Stripe is a great model. I think at the last round, it was around about 700 million US that they raised. To answer your question, I think private equity would be the way to do it. All right. So the private equity model was and is to identify a suitable firm with solid upside, acquire that firm privately or via the public market, restructure it, and then sell it in a rising market. All right.
Right.
What we have seen, fundraising has gotten easier since capital is always chasing alpha and the rise of private credit as an asset class. All right. We see more advantages right now in being a private lender versus being a private equity owner, as the target returns that private equity owners we're looking at are roughly in the sweet spot for private credits. The greatest thing that we could do in the private credit market is that now we don't need to require an exit to achieve a return. So think about it. Private equity companies acquire a firm, they need to sell it in order to get a return. In private credit, you don't, because that debt is being serviced monthly.
Let me just take a step back there. That what you're saying is absolutely crazy. Right? It's different to what we've been taught. So let me just get this right. There's more benefit right now to being a private lender than an actual private equity owner, as we've been taught. The vast majority of multi-billionaires, they're in the private equity ownership space. But you're saying that it's actually better to be in the to be a private lender, at least this point in the market.
Absolutely. So let's look at fixed income as an asset class. The risk is always going to be default, all right? If a creditor or if the credit system falls. Let's think African Bank in 2014 and how it affected institutional money markets.
Yeah.
But being higher up in the capital stack does give us more protection than equity investors would have.
Right. So capital stack, just run us through that one.
Capital stack is just the order of priority repayments on default. So think about it. Senior debt gets settled first, junior debt, hybrid, shareholder loans, then preference shares, then common shares. So being at the top of the capital stack gives you priority to be repaid.
That makes sense. So they're at the top of the list. They're always going to get the capital back first.
Absolutely.
And that's sort of what makes it a safer investment. Yeah. I don't know if this is for everyone. Should an investor who's like actually happy with the traditional portfolio actually like dig into alternatives?
Our viewers have seen the disclaimers, right?
We have to make sure that we show them at the end again.
Okay. So my take is yes and no, but I'm leaning more towards no, in a sense that if there isn't a pain point, don't make a decision based on what everybody else is doing.
Right. That makes a lot of sense. On the topic of pain points, what sort of pain points are you seeing, and what really does that mean? Most retail investors don't really think in terms of pain points. Do you want to maybe just expand on that?
Absolutely. So I'm not going to speak to the entire community at large about what the different pain points or challenges are. All I can speak to are the pain points or challenges that our clients have experienced, which led them to us. The number one challenge has been exhaustion. So our clients consistently highlight one primary frustration, and that is investment fatigue. They express exhaustion at being presented with the same investment opportunities repeatedly when they have new capital to deploy. The next one we've seen is low public market correlation. So public is highly liquid and private isn't. Liquid is having real-time sentiment-driven pricing versus private being fundamentals-based pricing. Right. So if you think about it, the Reserve Bank increases or reduces interest rates, and then you get a notification from your bank saying that your home loan is increased or decreased. So looking at that. And lastly, which is something that appeals to me, which is status. So let's think of a hot stock right now, which is NVIDIA, even though it's come down a bit. Everyone can buy those shares now. But imagine being the individual that says, yes, I own them while they were pre-IPO or while they were private. I think that pretty much is a status thing, right?
Yeah, and you could buy up to 12 yachts as well. So, just exhaustion was an interesting one. When you say exhaustion, do you mean that, from where we're standing, there's a ton of options, right? Are we saying that the combination of options are essentially the same thing and they're sort of with the same combination of things and that's why they move?
It could be, right? So it could be an individual has X amount of capital and the advisory firm is prompting them to the same asset time and time again, whether that be bonds, whether that be general equities, whatever the case might be. It's clients asking, we've got X basket of goods. How can we find assets that we don't have exposure to?
Right. That makes a lot of sense. But you know what's more interesting is that for sophisticated investors like this, it's like, I wouldn't I get number two. There's a logical reason there. It's sentiment, market driven, public market driven. But number one and number three the reasons seem almost emotional than logical. And I think that's quite an interesting insight that the one is they're really getting tired of the same thing. So they want, I guess, a little bit of novelty.
Yeah.
But novelty with all of the bells and whistles, I guess. I think status, I never would have imagined those are like the major pain points. Is that sort of something standard you're seeing across your clients?
Yeah. So I think emotion plays a huge part in it, right? So let me try and address it. Public market listings have been on the decline for over the past few decades, right? And founders are wanting to remain private for longer. Public markets have become excellent at being efficient and therefore reduce opportunities for excess returns. It's difficult to achieve alpha via public markets due to the reduction of public companies. Investors, just to come back to the point, are human, right? And I think it's emotion that allows them to follow what the bigger investors are doing. Does it make sense?
Right. Yeah, absolutely.
Right?
Absolutely.
What we've seen is that the top 200 US and Far East families have 45% exposure of their capital into alternatives as an asset class. Over 45%, Bruce.
So let me just recap that. The top 200 US and Far East families have over 45% of their capital into alternatives. I never would have imagined that number would be so high.
Just to give you an example, if you want a family or a family office, the minimum capital that's needed is 100 million US. So imagine the top 200, what their assets under management are sitting at. They've got 45% of that capital into alternatives. Okay. Over the past 10 years, we've seen inflows from PitchBook or Preqin that investor inflows into private markets have increased from 4 trillion to 15 trillion US dollars.
4 to 15, that's like 400% increase, right?
Yeah. And imagine the zeros that's in a trillion, right? It's going to be difficult to read.
Yeah,
and this
exactly.
This has been led by institutions, hedge funds, sovereign wealth funds, and ultra-high net worth individuals.
Right.
These individuals make up 30% of that 15 trillion that's in individual hands. And these individuals in their personal capacity have around 25% into alternative assets. Investors are always thinking, how can we add diversification and uncorrelated returns into our portfolios, which is when they come to us. I think in this regard, private portfolios provide an increased return and reduced risk, which we hopefully will explore later on.
Right. And I'm happy to explore that later on as well. But I'm hearing only good things. Right? I'm only hearing good things. And if you're on this earth, you know that there's always going to be an upside. So what are the problems here? What are you not telling us?
Okay. So the first problem is always going to be access, right? Because you have to be a professional client to gain access here. A professional client is ultra high net worth individual. So they've got around about 30 million US capital to deploy. It's institutional money and high net worth individuals. So individuals who've got about $1 million US that they want to deploy. A professional client is a person or an entity that is allowed to invest in securities that are not registered with the Securities and Exchange Commission in the US. Right. Problem 2 is that this asset class is a marriage. So clients need to be in for the longer time than public markets without ever having access to capital. But now we're seeing there are some private structures
that
that are
up
becoming
the capital
more
for a longer period.
Absolutely.
Yeah.
So it's not like the public market where it's going to be traded daily. Here, you're going to be locked in for a long period of time. I think clients
that makes sense.
should... No, absolutely. And I think if you're locking in capital for a longer period, clients should always use private markets. And I've got to stress this point, to aid their current investments, not to replace them, to help achieve alpha, to help get income, and to aid diversification. I think over the last 24 months, I've seen our clients diversify to alternatives. And what we're seeing now is that our clients are diversifying within alternatives. So if you're diversifying across private markets and you are still then achieving alpha, I think that's true double diversification.
You mentioned your clients. Who are your clients? Like, what? Obviously, without mentioning any names, what sort of profile are we looking at here?
Yeah, no, listen, we in the private sphere, right? Confidentiality is everything here. We serve our clients who are situated globally. They are public and private pension funds. They are foundations and charities. They are banks and insurance firms. They are sovereign wealth funds, although much, much lower volumes. They are asset managers. They are family offices. Again, they are ultra high net worth investors, and they are high net worth investors.
Right. So, and the focus here when servicing is really to provide them with private credit. And could you talk us through what exactly that is and what that looks like?
Yeah. So just to take a step back, Bruce, these investors don't come to us for private credit. or they come to us because they've done enough analysis to say that they need exposure to asset A in territory B with this security. Once they find that out, they need somebody to originate the structure. That's when they come to us. So just to answer your question again, all right, so private credit is a loan made between a borrower, who is a private firm, and a non-bank lender, which isn't traded on public markets. It used to be that these loans were made to non-investment grade firms, which is something I'm seeing fewer and fewer of these days, Bruce. So private credits are essentially the new banks, but with less regulation and higher fees, right? Makes sense. So let's try and break this down, all right? So public markets are bonds that trade openly. So think Apple's corporate debt and US treasuries. Then there are private credit, which are loans that don't trade publicly. The key differences here is that these loans are held until maturity, so there's no daily price swings. They are direct lending, so there's no bank as an intermediary. And they are tailored structures, which means they are much more flexible than traditional lenders.
Tailored structures. That's really interesting, yeah. Because if I go to the bank, doesn't matter how big of a loan I try and take it, there's no way I'm going to be able to be flexible at all. What do you mean by tailored structure, and what does the tailored structure look like?
Okay, not to go into too much detail. It could be around the covenant flexibility. It could be around the pricing and return mechanism, the collateral structure. It could be the customized repayment terms or risk mitigation techniques. It could be how the debt is layered, or possibly have customized provisions in the event of default.
Please tell me more. Don't stop there.
All right. Okay. Listen, there's nothing new about private credit because people have been privately lending money to businesses for centuries. But today it just happens to be a big business. So the biggest PE firms or private equity firms are now calling themselves alternative asset managers. Why? Because the money here is just too good to ignore. Private credit has grown by 1 trillion in just a decade. Just look at us, We're just throwing $1 trillion like it's chump change. And it's now one of the most profitable corners of Wall Street. Banks are losing market share to private lenders.
Right. Quite interesting that this space has popped up like this. Kind of takes me back to 2008, the global financial crisis, the GFC. And I think there was a little bit of a dip here. Has the GFC kind of impacted this asset class at all?
That's a very, very pertinent question. I think since the GFC or global financial crisis, banks have faced stricter regulations around who they give capital to and how. Capital requirements have changed, and so has the way that the banks view risk. We have seen banks and private investment capital team up to create new service offerings. One instance of this are the partnerships on new originations or new deals that allows banks to retain customer relationships. Something that has been in the news lately is SRTs, or synthetic risk transfers, which is a way for banks to move the credit risk from their book to investors without having the need to sell the underlying asset. Therefore, what this means is that they are reducing the risk of a default on the bank's loan book, which is absolutely remarkable.
That is probably one of the most innovative things I've ever heard.
Absolutely.
Why do you think private credit's growing so fast?
Okay, so since 2008, banks have pulled back from risky lending. Private equity firms saw a gold mine in lending, and they've jumped in. So let's look at this, right? It's a $10 billion fund, and they operate on a 2 and 20 model. So what that means, it's 2% annual management fees and a 20% bonus. This 2% on a $10 billion fund equals $200 million a year in fees, all right? The funny point is, think of why so many banks have their own internal unit trusts, right? It's due to fees.
Yeah, exactly.
100%. There are some big names in the market. So think Blackstone, Apollo, please remember this name, KKR, Eris, Oaktree. They all have pivoted into private credits. They realized that they could make money on both sides of the transaction, which is a physical lending or buying the credits in transaction and getting paid the interest. Now, these firms are able to finance their competitors' leverage buyouts and get paid for it, which is absolutely remarkable.
So they're financing their competitors' leverage buyout and then getting paid for it.
Paid for it, absolutely.
That's incredible. You mentioned a kind of interesting names there. Apollo, KKR, Ares. Tell us a bit more about those names, Blackstone, and what they represent.
Yeah, absolutely. Let's use Iris as an example, right? They're a huge player in the US market. They win by lending capital versus private equity exits.
Right.
They do mid-market lending, so loans to firms that are too big for banks, but too small to raise in the bond market.
Right.
Their loans are secured against assets. They have a floating rate, and they have thousands of borrowers, so the concentration risk is low. The old business model for these firms was institutions buying into bank package loans in the credit markets. Now the middleman is out, and these companies are originating the business directly. They have a huge institutional demand from pension funds, as pension funds need a steady monthly cash flow to assist with their distributions to their members.
That's right.
Iris also has a special opportunities fund that lends to distressed and restructuring firms.
Correct.
This fund size is around $5.5 billion US dollars, and the returns since 2018 have been above 25% in USD per year. Can you believe that, Bruce?
That is insane. 25%. You mentioned distressed firms. That does sound like a bit of a risky area to play in. Do you want to sort of define that?
Yes, distress and restructuring firms, right? So if we look at distress, it's a type of debt that's carried by an organization in which they have too much of it to refinance, or they're unable to meet the requirements of the existing debt agreements. So that's what you call a distressed situation. Stress situations are always available at a discount. So a lot of these companies will purchase it for the upside that's currently available. Structuring is when a firm makes significant changes to their operational or financial structure. And often this is to improve profitability, efficiency, or just to better align with the current business needs. Okay, did that answer it?
Yeah, absolutely. Look, I think the founders of those companies are probably the Ares and Apollos. They're probably multi-billionaires over and over and over again.
The initial founders and the CEO of Ares are all multi-billionaires because of the returns that's currently happened. I mean, the assets under management for Ares are around about $350 billion US dollars. The return unannualized in the last 60 months has been around about 316% unannualized versus the S&P, which has come in at 56%. They also get around $2 billion a year in management fees. And at the last count, they had about, I'm going to teach you a new phrase, right? It's called dry powder.
Dry powder
means...
That sounds suspicious.
Dry powder just means how much of cash does a firm have ready to be deployed into assets. That's dry powder.
Right.
Ares has around about 135 billion in dry powder, which is capital ready to be deployed. Okay. The greatest part is that they control who gets money and at what terms. And I can't believe I'm going to say this, but it's making banks seem less relevant. All right. I say this because of the news that dropped last week regarding Meta, that they are in talks with Apollo, who's an alternative asset manager, for a private credit raise of $35 billion. Meta with their data centers globally.
Meta as in Facebook, right?
Facebook, correct. I think I might have sent you the link. If you're not sure, just let me know. We can try and get it to our audience now.
I'll drop that in the chat for the guys right now.
Perfect. The interesting fact about this is that Meta isn't an emerging company. It is one of the top 7 in the US stock market. Meta won't struggle to raise money in traditional capital markets, nor would it battle to raise money through banks. So the question is, why did they go this route? And not to give the answer, I think this might be good homework for our audience.
Yeah, you're giving us all homework. That's okay. That's okay. We'll take it. But that is a really interesting question. And so sort of going on that, what is private credit financing in particular? Like how is it structured and what forms does it actually take? Especially looking at the one that you just spoke about with Meta.
So private credit is corporate loans. I mean, there are even blue chip companies like Facebook who are using private lenders. It's infrastructure and real estate, so data centers again, energy or logistics. Growth stage tech, which means it's companies that are too risky for banks. It's consumer lending, which is these buy now, pay later startups that you see all over South African retail shop windows. Or there's litigation finance, which is funding class action lawsuits to get a piece of the winnings at verdict.
Right. That one's quite interesting. Is that quite common in South Africa as well?
I haven't seen it in South Africa, US, UK markets predominantly.
Right.
I think the thing that we need to learn from here is that if there's risk, there's yield, and private credit will find a way to finance it.
Yeah, it's private credit sounds fascinating, but what exactly makes it so enticing?
So private funds or private credit funds have one huge advantage over the banks. They raise money from institutions and ultra high net worth investors who agree to lock up this capital for years. This means the fund doesn't have to sell in a crisis. They can lend to riskier companies that the banks would reject, or they can structure loans that the banks wouldn't offer. I think for borrowers with weak credit, like cash-strapped tech startups, private credit might be their only option. And because private credit firms take on more risk, they charge higher interest rates, and this means better rates to their investors.
I've heard excessive returns. There's got to be a catch. There's got to be a catch.
Listen, we call it a trade-off, right? If I want to acquire asset A, the trade-off is I need to be happy with option B. Private credit is much less transparent than public markets. So again, there's no daily pricing. Fund managers value their own assets, which is a huge conflict of interest. Different lenders to the same company report different loan values. And a reality check is that some of these funds may delay marking down bad loans, leading to a sudden massive losses later on.
So when it comes to your clients specifically, and again, without discussing any sort of confidentiality agreements, in terms of security, what about when a private credit transaction is being structured? What are clients looking for in a private credit transaction?
I think that's a great question, Bruce. Every client's different, and every client has an internal view of what security means for them. What we have seen clients asking for, and this is in no order of protection. We've seen them ask for senior debt, which is priority in the capital stack. We've seen them ask who are the current backers. Example, is Eris leading this round of funding? Because if they are, I want to go and follow them. It's 100% loan to value, which means if we're lending a company money, we want to make sure that their assets 100% cover the value of the loan. There are some clients who look for liquidity, which is, can we access our funds after 12 months? Or is there a secondary market that's been created that allows me to sell and a secondary investor coming on board the transaction? Some clients look for this transaction to be listed on a stock exchange for added regulatory and compliance measures. In some extreme cases, we've seen clients ask that a trustee takes over the firm's assets until the raise is complete and the funds have been repaid. We've also seen corporate guarantees, which is an insurance product that pays out if a company goes into default. We've seen track record. So if Max Agility is raising 5 million a year and every single year we've paid back investors, that gives us a track record. Clients want to get behind us because of that. There are segregated funds, which means once the capital has been deployed, it's sitting in a separate bank account that the company uses for its daily operations. Or it could be a settlement agent, which means that the settlement agent would be responsible for getting the client's funds out for liquidity. I hope that sheds some light.
Shed a lot of light. Thank you. So from what you've seen with investors managing their own money, what are they doing?
Yeah, no, absolutely. I think our core investors are LPs, limited partners. A limited partner is an investor who provides capital into any partnership structure. I think private equity fund, private credit fund, venture capital fund. They have limited liability and limited involvement in the day-to-day. The law says that they have to be passive to preserve their limited status as per the limited partners agreement. Investors or LPs manage their own capital, and there's 4 key reasons for doing so, which I think we've touched on earlier, which is to provide aid to their current portfolios, not replacing public allocations. It's to achieve alpha, receive income, and for added diversification. I think when our clients consider private markets, it's usually from a fixed income perspective. So not the normal traditional 60-40 split, right? Which is 60 in stock, 40 in fixed income. Our clients' core approach is that 60 to 70% of their capital is into fixed income with zero leverage attached to it. So it gives them a more predetermined rate upfront. Does it make sense?
Absolutely. So this predetermined rate is obviously higher, right? But how much higher are we talking about, Karson?
All right. So I'd say an average private credit transaction is around 600 basis points higher than cash yields. All right. This is called the illiquidity premium, or the extra basis points for not being able to access your capital. Think of a 1-year fixed deposit at a bank and the rate that you get versus a 5-year fixed deposit. It's the same thing. It's an illiquidity premium. Our clients, their non-core approach, which is the 20 to 30% of their capital, has been in extremely highly leveraged transactions. And these allocations are in private equity and venture capital assets.
So how are they diversifying?
Okay, I got to make this point up front, is that we don't, and we have never advised clients on what their allocation percentages should be. We always go according to what their instructions are.
All right. So should we put the disclaimer up again, right?
Yeah. So I think something that has played a crucial role is, how do they diversify? While it's not something that we advise on, all of our clients have teams of tax and legal consultants, or at the very least, a tax and legal advisor.
Right.
What I have seen is that they fund assets from the same asset class. So what that means is that if they want additional exposure in private credit, they fund private credit from public credit, right? So they're taking funds from your public fixed income, and now they're putting it into private fixed income, or vice versa. We've also seen our clients navigate in private markets and diversify through private equity funds with varying strategies, private credit again, distressed debt, real assets, which are real estate and infrastructure, and much bigger ticket sizes in venture capital. A bigger ticket size means is, what is the amount in the check that you're cashing for the transaction?
Right. Just so I get this right, they're using the same type of investment that they would have invested, or that they are investing in the public market, and then just changing from public to private, so they can be able to,
depending on what percentage they think is. Absolutely.
Brilliant. What other assets have people allocated to?
We haven't done this at our firm, but I have seen other transactions where clients have asked for allocations in art, in sports teams, in data infrastructure, music royalties, litigation, sports, timber, healthcare royalties, and these buy now, pay later ventures.
That's really interesting.
Which one?
I get the AI, the high tech, bleeding edge technology type of investments, but timber is in that list of sort of high tech technology, buy now, pay later, sort of innovative class. Yeah. Timber seems a bit like it doesn't really belong there, but it is.
Just that we haven't dealt with it as an asset class, but the thing that I know is that the US has a legacy system regarding timber manufacturing. Think of all of their homes are always made out of wood. It could be also the carbon offsets that come up, or perhaps that you could re-harvest the same tree once it grows. I haven't done it, so I think maybe those could be possible ideas.
That would make a lot of sense. That absolutely make a lot of sense. So what should investors consider when they're actually moving into alternatives?
Fantastic question. I think the most important thing when entering private markets or the alternative investment space, it's that it is advisable to always contact a capital markets professional first.
Right.
I think it's common knowledge now, and in every webinar over the last 18 months, that bonds usually provided protection from stocks with its negative correlation. But I think with higher inflation, it's made this negative correlation go to 1, which meaning that it's not always going to provide security. I feel that the way companies have funded themselves has changed, and we should begin to look here. If you're looking for innovation, you need to enter the private markets. So think Uber and Airbnb before they listed. As an investor, you need to know if your invested capital needs to achieve income or capital growth. I think asset-backed lending has become an attractive alternative to traditional direct lending, as banks are trying to navigate their capital requirements and optimize their balance sheets.
Right.
Our investors have 2 approaches. I think the first one is looking predominantly to direct lending in the case of private credit, as the client wants to underwrite the deal. All right.
Right.
The second approach is investing as a limited partner in a fund that does that for you. But this then reduces the returns dramatically. In my personal case, I think it's around the need to move where the crowd isn't. And if there isn't a crowd, there's not going to be much regulation. So you need to be financially astute and be prudent in how you read the market. I think public listings and capital market activities have been low, which means the opportunities are now in the private market, especially in the secondary PE, VC, and private credit space. Do you know what a secondary market is, Bruce? Because if you don't know, I'd like to explain it for all.
Take us through that. Take us through that.
Okay.
I'm going to say I do know, but let's explain it for the audience. I'll hide behind them for now.
Okay. So primary market is that there's a private credit fund that's raising money. I, as an individual, put in X amount of million into it. I'm a primary. I need to exit that due to another cause. I've got to find a buyer in the secondary market who will now take over my holdings. So that's a primary investor or the secondary investor. So think about this. I buy a brand new car from Audi. I'm now selling it to an individual who's now buying a second-hand vehicle. It's the same thing, primary and secondary market. And it's due to these individuals needing to leave to rebalance their portfolio. And this always presents a solid entry point for new investors. Our base of investors are around 60 plus global family offices, around 200 institutional clients, and around 800 ultra high net worth and high net worth individuals globally. Seeing how they navigate the markets gives us and me tremendous insight at Max Agility.
Right. I'm gonna pull on that string just a little bit, right? So when we're talking about when we're talking about the insights, I mean, I think you mentioned something around 60 family offices, 100 ultra high net worth individuals.
Correct.
That must mean you're beginning to see some trends, and you do have some insights for us.
Yeah.
For 2025 and beyond, what are we looking at?
Okay, just give me a second. I need to put this into something that sounds literate. So let's start with private equity as an asset class, right?
Right.
I think we see continued focus on sector specialization, particularly in technology, healthcare, and sustainability. I think there's going to be growing interest in the lower middle market as large cap valuations are going to continuously remain high. I think there's going to be increased adoption of continuation funds and other general partner-led secondaries to manage earlier portfolio exits. So I think that's something that could play out in private equity. In private credit, I'm seeing more expansion beyond traditional direct lending into specialized credit strategies. I see growing allocation to private credit as a true alternative to fixed income, and probably an increased focus on more distressed and special situations as the economic cycle moves through. Last, there could be more interest in asset-backed lending and specialized financing solutions. On real assets, I think it could be infrastructure investments that are tied into energy transition and digital transformation. I think there's going to be growing interest again in sustainable timber and agriculture as inflation edges, which I think it could be timber harvesting, maybe a carbon credit rating. Again, data centers, digital infrastructure, which will continue to attract significant capital, and possibly specialized healthcare real estate gaining traction, which we've seen. In venture capital, we've seen a more selective approach to early stage investing with more emphasis on the path to profitability. I've seen continued interest, or I see continued interest in AI, healthcare tech, climate tech, and cybersecurity, which I know is a big sector for you. I also currently see growth in emerging market venture capital ecosystems, which is the predominant market that Zion Venture Partners and I operate in, and possibly sector-specific micro funds that have very deep expertise. I think those are something that I'd look for over the next 18 months, and I think it'll be interesting to see how it plays out.
Right. Karson, thank you for those insights. We had 180, 200 people registered for this webinar. You mentioned a couple of things, and it really seems like very sort of exclusive opportunities. How many of those registrants are actually going to get an opportunity here? If we're being realistic about this.
So I think globally, what the SEC qualifies somebody to be a professional investor. It's probably maybe just less than 10%. So if you've got 100 people that are currently on this webinar, possibly might be between 6 and 9 that qualify. But I hope I've been of value in terms of the information that we've shared.
It's been absolutely valuable for me. I'm looking at some of the questions. We actually asked quite a few of the registrants to send through some questions. We got a great question. Eleanor Becker from CityWire, actually.
Okay, CityWire.
And she asks, right, I'm actually gonna drop this question in the chat for everyone as well, and then just highlight it. So she asked, what investments are available to SA clients who want ESG options? Are there any ESG aligned retirement funds?
Absolutely. Eleanor did drop that question to me before. I think I definitely need to jump on a call with her to unpack it a bit more, but I did make some calls just before we logged onto this webinar. So I think in terms of ESG alternatives in South Africa, there are some available options. They could look like green bonds that are issued by financial institutions or municipalities, or private equity funds with ESG mandates. I've also found that there are some ESG retirement options. There are several asset managers who offer ESG-focused unit trusts that qualify for retirement funds. I think people should look towards the direction of Allan Gray, Old Mutual, Sanlam 91, because they have some great products with ESG integration. And I do know that Regulation 28 encourages ESG consideration in investment decisions. So it could possibly be something to look at. I think the second question was around impact investing and whether it's only accessible to institutions. The thing is with impact investing is that you're going to need a large amount of capital to deploy to make a difference, right? So impact investing is anything that's going to, what's the right word? Underserviced community.
Right.
Whether it's through schools, whether it's through shopping malls, water infrastructure, whatever the case might be. All right? You need a lot of money. Impact investing has always lent towards institutional capital due to this, where a lot of the times the minimum ticket sizes are going to be either 100 or 500 million per ticket, which means it's only going to be a large firm that's going to be able to do it. I think there are some retail impact investing funds with lower minimum investments, maybe around 15 million. I think the minimum investment amounts have got to decrease, although it might be difficult to access this via unit trust. I think some of I've just got two names here. Some of the funds that I think people should start looking at, especially if it's impact, is Future Growth Community Property Fund. They invest in shopping centers serving previously disadvantaged communities. It could be 91 Global Environment Fund that invests in companies contributing to environmental solutions. And I think global impact funds accessible to South Africans here. One of the first ones I look at is Vital Capital Fund, which invests in sub-Saharan Africa, and it focuses on infrastructure, agribusiness, and affordable housing.
Thank you for that. There you go. Any other questions? Feel free to drop them in there. But I think we'll probably wrap this up now. If you want to contact Karson, hello@maxagility.co.za. I'll let you just drop that in the chat for everyone right now. It'll also be on the show notes screen. Please feel free to email Karson and his team at hello@maxagility. Visit maxagility.co.za, and we'll put the recording up. We'll also put a link to Karson's LinkedIn profile, so you can spam him there as well. Karson, thank you so much.
It's been a pleasure. Thank you for pushing me to do this.
As well. You're welcome.
Thank you very much. Just couldn't have done it without you.
You're very, very welcome. Thank you for sharing your vast knowledge with us and teaching us a little bit more about the world of alternative investing. I personally was afraid to ask those questions, but you've now addressed them, and it will help us to overcome our fears. You can reach out to Karson, hello@maxagility.co.za, or find him on LinkedIn. Thanks so much, everybody. Yes, one question's come through. But yes, the recording will be made available. I did mention that in the beginning.
I should have addressed that in my presentation.
Yeah, that's right. The recording will be made available. It will be on YouTube, it'll be on LinkedIn, and we'll also give you the deck if you ask me. Right. Have a great day, everyone. Thanks for tuning in, and reach out to Karson. hello@maxagility.co.za. Cheers, everyone.
Cool.
Bye
Thank
now.
you. Bye.